We're starting off with a story that's been making waves in the financial sector: Tesla's latest earnings report. The electric vehicle manufacturer is expected to release its second quarter results after the closing bell on Wednesday, and investors are eagerly awaiting the news. According to Bloomberg consensus estimates, Tesla is projected to report revenue of $26.21 billion, up 16% from a year ago, with adjusted earnings per share estimated at 50 cents. But what has really got everyone talking is the company's cash burn. Tesla's free cash flow is expected to be deeply negative, with estimates suggesting it could drop to as low as minus $3.254 billion for the quarter. This is largely due to the company's aggressive spending on capital expenditures, including production ramp-up for its Optimus humanoid robot and AI data center build-out. Now, some investors might be concerned about this level of cash burn, especially given the current market conditions. However, others argue that these investments are necessary for Tesla to maintain its competitive edge in the industry. As Morgan Stanley analyst Andrew Percoco noted, strong auto and energy deliveries set Tesla up for a solid quarter. But we believe the key investor debate remains unchanged. Can robotaxi and Optimus progress quickly enough to justify an accelerating AI investment cycle? It's a fair question, and one that we'll be keeping a close eye on as the story unfolds. Tesla's stock has been down around 16% this year, and investors are clearly waiting for signs of progress on these new initiatives. As we always say on the Riskwiser Zone, it's essential to approach investment decisions with a balanced perspective, considering both the potential risks and rewards. We'll be watching Tesla's earnings report closely and bringing you updates and analysis in the days and weeks ahead. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of high finance and geopolitics, where the stakes are always high and the players are always on the move. Today, we've got a story that's making waves in the investment community, courtesy of none other than J.P. Morgan Chase CEO Jamie Dimon. Now, Dimon is known for his straight-shooting style and his ability to read the tea leaves when it comes to market trends. And in a recent interview with Wilfred Frost on the Master Investor podcast, he had some choice words about the current state of the global economy. According to Dimon, investors are underestimating the risks facing the global economy, from wars in Ukraine and the Middle East to tensions between the US and China. Dimon warned that these risks could eventually rattle markets, and that's why he wouldn't be a buyer of either equities or long-dated US Treasuries at current prices. Now, this might sound like a contrarian view, given the recent surge in stocks and the relative calm in bond markets. But Dimon's argument is that these risks are simply not being priced in by investors. He also pointed out that the global economy has become more resilient due to lower energy dependence, but that doesn't eliminate the possibility of a sudden inflection point. And when it comes to US budget deficits, Dimon predicts that they will eventually force a reckoning, potentially driving interest rates higher. Now, I know some of you might be thinking, but Louis, what about the AI trade? Isn't that the next big thing? Well, Dimon had some thoughts on that too. He compared the current spending boom in AI to the early days of the internet, saying that, while it's likely to pay off in the long run, the timing and the winners are far from certain. As always, we want to provide a balanced view here on the Riskwiser Zone. So let's consider the counter-argument: maybe Dimon is being too cautious, and the market has already priced in these risks. Maybe the US economy is indeed more resilient than we think, and the AI trade will continue to drive growth. But one thing is for sure, when Jamie Dimon speaks, people listen. And his warnings about market risks are certainly worth considering, especially if you're a long-term investor looking to navigate these choppy waters. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a look at some exciting developments in the world of technology and finance. Samsung has just announced its first US credit card, the Samsung Galaxy Card, which offers 5% cash rewards on Samsung direct purchases. This move is seen as a challenge to Apple's similar offering, the Apple Card. The Samsung Galaxy Card will be issued by Barclays on the Visa network and will offer various perks, including deep integration with Samsung Wallet. Now, let's break down what this means for consumers. On one hand, the Samsung Galaxy Card offers some attractive rewards, especially for those already invested in the Samsung ecosystem. With 5% cash back on Samsung devices purchased directly from the company, it could be a great option for loyal customers. Additionally, the card offers 3% cash rewards on transactions made through Samsung Wallet and 2% cash rewards on online subscriptions like Disney Plus or Netflix. On the other hand, it's essential to consider the broader context of the credit card market. While the Samsung Galaxy Card may offer some unique benefits, it's crucial to weigh these against other credit card options that might provide higher rewards or more comprehensive benefits. Furthermore, as with any credit card, it's vital to carefully review the terms and conditions, including interest rates and fees, before applying. In conclusion, the introduction of the Samsung Galaxy Card represents an interesting development in the intersection of technology and finance. As consumers, it's essential to stay informed and make educated decisions about our financial products. Whether or not the Samsung Galaxy Card is the right choice for you will depend on your individual needs and preferences. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.